7% para la general, 4,3% para la subyacente. Este es el dato que ha gustado al mercado, no tanto el general, porque ha batido expectativas o ha empeorado respecto a expectativas, porque ha subido más de lo que se había esperado por los analistas. Tenemos ya con nosotros a Edward Moya, Chief Market Strategist en Market Pulse Anoanda. Edward, as always, thank you so much for being in Negocios Televisión. Good afternoon, good morning for you.
Oh, thank you for having me.
Edward, is this uptick in inflation in the United States really something that we should worry about? Because primarily we can explain this increase with gasoline prices.
I think for a lot of people on Wall Street, there was, a strong expectation that we were going to see energy prices really weigh on this data point. And I think, for the most part, the report did show a little bit of a reacceleration, but there is a strong consensus that this economy is starting to weaken, and that should do the trick for letting the disinflation process remain intact. When you take a look at the 3-month average, everything is still trending lower, and I think there's still expectations that prices are going to come down in the coming months.
On a monthly basis, inflation has met expectations in headline and in core data. Is this really what is most important, the monthly basis, the monthly data?
I think for determining your outlook for risky assets, you want to see that inflation is coming down, and I think the important part is expectations. I think this is where people don't want to see inflation embedded into their outlooks, and I think right now, if we continue to see core growing at 0.2 or with maybe a surprise here or there at 0.3, that is tolerable. And I think that you're probably going to still see that as this economy starts to see a much weaker consumer, that is likely to help with, I think, bringing pricing pressures down. I think when you take a look at shelter prices, which makes up 40% of core, there's, I think, good expectations that, the peak's in place for rents and that this should trend in favor for the Fed. And I think it'll be a coin flip on whether or not they have to do one more rate hike. But I think there's probably going to be a consensus once we start to see weaker data points for the economy and the consumer that the Fed could possibly be done already.
Core inflation, Edward, has gone up slightly more than it was expected on an annual basis. Is this going to be something that will worry the Federal Reserve, Jerome Powell?
I think, when we saw the initial market reaction, everyone was so focused on supercore, and that accelerated, the most, since March. And this is a key measure. I think, though, there's still a strong backdrop here that the economy is probably not going to see a significant reacceleration. Yes, we have been talking about economic resilience over these past several months. That is starting to wind down, and I think as we start to look ahead, fourth quarter or even holidays, there's a much weaker consumer that is clearly being outlined, and credit markets aren't really getting worried just yet. But I think we are starting to see, the signs that we could have a much more pronounced labor slowdown in these coming months.
To correct myself, I said core inflation has gone slightly up more than it was expected on an annual basis. I meant a monthly basis. You already mentioned what the Federal Reserve might do next week, but I wanted to ask you again about this. What do you think these numbers might imply about next week's Fed meeting? Do you think that we will still see a pause in the Federal Reserve rate hikes, even though we've had this slight uptick in inflation?
I think this inflation report gave a little bit for both the hawks and the doves. The Fed is likely to skip, any rate hikes at the September 20th meeting. But I think what they're going to do is they're going to try to drive home that higher for longer narrative. You can't, ignore, the increase that is highlighted with core with this month's report, and I think. The Fed is probably going to try to convince markets that policy will remain restrictive a lot longer than they're expecting, and that rate cut bets will probably need to get pushed back into the second half of next year. But I think overall, this is a Fed that is going to start to show divide, and that's probably going to be a welcome sign by markets, which means the peak in tightening is very close, and I think what we'll start to do is see more weakness with the economy. But I think that is something that we're not going to see a very hard landing. I think there's still expectations that we will have some maybe 1/4 of contraction, but a severe recession is not in the game plan right now, and I think there's expectations this economy is going to moderate, and it's not going to have that hard landing that a lot of people were fearful at the beginning of the year.
For the inflation report, I wanted to ask you about the gasoline prices spike, because I guess this is the main reason why inflation has gone up in August. But why have gasoline prices spiked this much? Is it all the OPEC in this case and the Saudi production cuts, or is there something else that we can use to explain this spike in gasoline prices?
Well, I think this oil market was going to remain tight before that OPEC decision, and I think at the end of the month, when the Saudis and Russians kind of surprised markets that they were going to keep this market tight throughout the end of the year, I think energy traders were so fixated that we were going to have like a 1 million barrel per day supply deficit in the fourth quarter. After that decision, the initial thinking was that it was going to be a 2 million barrel per day. And now further research is showing that it could be around 3.3. So this market is going to remain tight. Even if we start to see that economic slowdown that I highlighted earlier, demand destruction isn't going to be as quick. So higher energy prices are not going away anytime soon. So the risks of $100 oil are here, and you're probably going to see that gasoline prices are going to remain elevated in the next inflation report and the following one, and that will obviously complicate the disinflation process that appears to be holding up. So I think the risks that an energy crisis could really complicate what policymakers do globally is going to be a big dominant theme going forward. But I think the risks are to higher energy prices. Gasoline should continue to I think surge over these next couple of months, and that would be something that will draw a lot of attention and could tilt the scales possibly that maybe more tightening will have to be done.
Moya, Chief Market Strategist at Marco Posano Anda, thank you so much as always for being in Office Televisión. It's been a pleasure to speak to you. Thank you.
Thank you.
Bueno, pues